Hello financial investors and welcome to the channel. My name is Brent and today we're going to be going through our third set of Dividend Aristocrats, going through numbers 21 through 30. We have a pretty good amount of stocks to cover today, so we're going to go ahead and dive into it here in just a minute. But prior to that, I want to go over how we've recently changed the YouTube channel. If there's any specific videos you would like more information on, definitely let me know down in the comment section below. I'm looking for any sort of feedback from the viewers, the subscribers out there, to see what kind of content you would like to have more here on the channel. If you'd like to have more videos on savings, stock market, dividends, real estate, I'm interested in finding out what you guys are looking for. So without further ado, if you are brand new to the channel, I'd really appreciate it if you do hit that subscribe button below. If you do enjoy this video, find it helpful, hit the thumbs up. And if you have any comments or questions or want to give me some feedback, always just drop it down in the comment section. I do read and reply to every single comment. And let's go ahead and get into the video. So I've recently revamped my YouTube channel. So if you go to the home page here, if you just arrive on my channel page, I'll have a bunch of videos segmented here by what they go through. Popular uploads are up top. Next, it goes into the savings portion, how to save and increase your money. So I'm going to start making more videos. Obviously, I don't have too many there, but that's something I kind of see now visually, that I would like to produce more videos on how to save and also grow your money, creating different streams of income ideas. So we'll kind of get into that. I also have investing, how to invest in the stock market. So I have multiple playlists there of how to invest in the stock market, either just general stock market investing videos, stocks that I'm buying or watching, dividend stocks going ex-dividend. This was a series that I did for quite a while back in 2017, some 2018. Goes over stocks going ex-dividend for the upcoming weeks. I may bring that back and do it monthly. Stocks going stock weekly recaps. This is something I've also kind of getting back into recently. And then stock market pullbacks and corrections as we move forward in the market. As there are corrections or pullback of 2% or more, maybe I'll make a video on it, kind of going in what took place that specific day in order to have caused the market to pull back. Then it goes into the brokers. I discuss many different brokers here on the channel. We go into videos specifically for M1 Finance, for Merrill Edge, Robinhood, how M1 Finance works, Webull, and then there's a few others here, Acorns and Stash. Not too popular topics that I've discussed. It goes into the real estate investing videos that I've discussed, real estate investing, government securities, savings bonds, treasury bonds, business information, kind of going over sole proprietorships or limited liability companies, 5 factors that influence the way that you should start your business, digital product ideas, and then it kind of goes into just specific content created here for the channel, financial investor channel business content. What I've sort of discussed here on the channel kind of goes into that. So that was a very quick recap of how I've recently changed the channel. I will be creating new content, kind of going into those specific segments, how to save your money, grow your money, stock market investing, real estate investing, going in and investing in bonds and securities. I think is an interesting topic if you're looking for something a little bit safer. But okay, so we've kind of knocked that out. Now we've already gone through our 1 through 20 stocks. And our last video was fairly 50 minutes, so I'm not going to be trying to make it that long this time. We're going to be starting with ticker symbol NUE, the Nucor Corporation. It's a gold mining company, and we're going to go up to Clorox, ticker symbol CLX. So we have a couple companies in here. These have all grown and paid out dividends for the past 25 years or longer. We can see here Genuine Parts has been growing and paying out dividends for the past 6 to 3 years, has had a current dividend yield of 3.01%, and that may or may not have fluctuated since this was posted quite a bit ago. So it's very interesting here. So I've already put them into the graph. I'm sorry for the blinding screen here, but we'll kind of go into these companies here. And what we want to cover, first of all, I'm going to have all of the timestamps down in the description below. That way, if you're just interested in finding out a little bit about one specific company, you guys will be able to visit the timestamps to kind of just jump into what was discussed on that specific company. Okay, so we're going to be starting off with Nucor Corp. Now, looking at the 1-year chart, where is this company currently? It is down, trading near 52-week lows. Here it is in the blue, current price $47.95, putting it below its 50-day and 200-day moving average, up in the 50s. Now, at the current time frame over the past year, this company is trading at what appear to be a value, opportunity. Its dividend yield is at 3.34%, putting it at one of the highest starting yields for the past year. If you look over the past 10 years, where has this company moved? Now, not a lot of growth here over the past 10 years. We'll bring in our percentages here in just a minute. We'll go ahead and bring up percentages right now, actually, and we'll take out 50-day, 200-day moving average and just look at that price, and we'll throw in their revenue, net income, and free cash flow over the past 10 years. This company, over the past 10 years, their price in the blue has grown 16.58%. That is not very much for, any company out there. Over 10 years, that's an increase of 1.6% on average per year. A lot of investors would look at this, and over the past 10 years, last year alone, half of last year was 15% because the total market return was around 30%. So this over 10 years only made half of what the S&P 500 made in 2019. So not a great long-term investment if you're looking for capital growth, but if you're looking for maybe something in the short term that could be a hedge, to say gold mining company, it could potentially offer that. If we just remove the price now and just look at where the financials have gone over the past 10 years, we can see that overall its revenue has been increasing, net income has also been increasing recently as of say 2016 and has recently came down, and its free cash flow is up over the past 10 years by 59%. If you divide these numbers by 10, you'll get their yearly average. So for example, revenue is 85 divided by 10 is 8.5% on average over the past 10 years. So this is a really good example of just because a company has rising revenue, rising net income, and free cash flow, it doesn't exactly mean that the appreciation for the company will rise as well. We'll go ahead and just throw in earnings in here really quickly. I don't want to go into debt and a bunch of other statistics here in this video just because I think it really rocked it. So here's where their issues at right now. If you look at over the past 10 years, where has this company gone? Why is this only displaying only so much information? So let's look at, it's not really displaying too much. Maybe we can look at this one. This one seems to go back a little bit further. Okay, so earnings per share trailing 12 months. So over the past 10 years, this company had rising revenues. Here's that 2016 dip. And then I believe their share price had appreciated during the same time frame here. So yeah, here's where their company began to turn around with their earnings per share beginning to rise in the orange. Their share price also followed. Now here, we can see that share price began to fall, earnings began to fall here just slightly after. So maybe there was a little bit of a worry here. They released they came out, downgraded themselves, saying that they're expecting lower earnings guidance for the year, and their share price followed first, and then their earnings began to kind of go the way that they had guided. So this is kind of an instance there where lowering earnings per share has caused this company to fall here in the short term. So that is going to be ticker symbol NUE. Now, jumping into Genuine Parts Company, this is one that I buy and hold now. I'm a shareholder. Quick disclaimer, I do own ticker symbol GPC. Now, looking at it in the 1 year time frame, is this company trading at highs or lows? Now, this company here is trading almost near 52-week lows, down in the 80s. It is currently at $96.96, putting it below both its 200-day and 50-day moving average. Over the past 10 years, it's not at its highest yield on cost. You would say, you could see here that at some time back in the last 6 months, it's been around, say, 3.4, 3.3% starting yield. It's currently offering a 3.15%. So over the past 10 years, let's see where it's gone as far as growth. So over the past 10 years, there has been some appreciation in this company. If we bring in their revenue, free cash flow, and net income, look at this over the percentage-wise, over the past 10 years, this company has gone up 153.9%, or roughly 15.3% on average per year, which is good for this style of company. You can see as of 2015, though, they've had some issues where they've really just kind of sidetracked. The company itself really hasn't gone anywhere. If you looked at the S&P 500 from around 2013, 2014 up until 2018, 2019, it also had this sort of stale. It wasn't until recently where the S&P 500 in 2019 put on that additional 30%, which really kind of spiked it. So Genuine Parts is looking like it's consolidated. It's been consolidating for quite a while. It is trading at lows for the current range over the past 5 years. But what has caused this to happen, and what we could see here is overall, if we go ahead and just take out their price now that we've kind of seen their price over the past 10 years, it's actually decent, over 10% on average. We can see that their revenue has been growing at 8.8% over the past 10 years. Their net income has also been growing at 9.4%, and their free cash flow fluctuates just depending on the year. Sometimes they build up a good amount of free cash flow, then they without looking deeper into it, you can see it goes down, it goes up, down, up. It's just a pattern. This is a sales driven company, so something's just kind of going on there. I don't know that information offhand. But overall, they haven't had any sort of recent decreases in their revenue or net income. If we look at their earnings per share trailing 12 months, let's go ahead and look at this one. Oops, let's take out the percentages there. And just look at the earnings per share over the past 10 years. They have been just going constantly in the positive direction. There was a bit of an issue here. Looks like maybe 2018 or so, which caused their earnings per share to kind of guide down lower. But recent times have shown that they're continuing to move forward, paying out, or they have earnings per share of $5.45. And if we look at their payout ratio, or their payout, how much they pay out in their dividends, it's 76 cents per share each quarter. Multiply that by 4. We'll say it's $1.52, right? $1.52 by 2 is $4.04 or so, somewhere around there. And they had earnings per share of $5.45. So they have a pretty good payout ratio. It's not too high. I think it's around 60 or so percent of their earnings are getting paid out to shareholders. So that is Genuine Parts and Company. Next, we're going to go ahead and go into CFR. Let's go ahead and pull in their price, dividend yield, 200-day, 50-day moving average, and make sure I have nothing else selected. Go back to their 1 year. Looking at it currently over the past 1 year, this company appears to be trading right in the middle. It's not at 52-week lows, is not at 52-week highs. It's right splat in the middle, trading actually in the middle between their 200-day and 50-day moving average of $93.80. Again, their yield kind of shows the same. It's not trading at lows for the year, low yield of say 2.45%, or it's not trading at highs of say 3.3%. It's right at 3%. So there's about a 0.3% difference up and down as far as their starting yield, and their price has appreciated. It's actually about the same too. So about 3%. I don't know the percentage here and change, but it definitely has had some lows. And I think Colin and Frost has actually been on my watch list for a while. Back in 2019, I added it in there. I just never made the buy on this, but it still looked like an interesting company. So here over the past 1 year, it's not really at a high, it's not really at low, so it's a pretty good average price. Now over the past 10 years, let's go ahead and remove these numbers here and look at the price appreciation. So this company has grown about 79.49% over the past 10 years. So that's about 7.9% on average. You can see here during some sort of something took a hit here and end of 2015, and they just kind of fell very hard, putting them actually into the negative over the past 5 years. And then they just recently had a lot of their growth here just over the last 4-5 years. Now, if we bring in their revenue, net income, and free cash flow, we can kind of see, maybe we can see what took place here during this time frame that would have caused them to have fallen by a decent amount here in 2016. It looks like maybe their revenue had just a small issue here where they, it doesn't look like much here, just kind of looking at the revenue. It did dip though, right in the kind of same time frame that this price dropped. So for whatever reason, rising revenue maybe kind of drove off some investors, caused some of that price to fall. And right away, we can see that revenue picked back up here in the orange, just orange is actually revenue. So orange remained pretty steady. So what is in the red? Red is their net income. Okay, so red income, net income, and kind of slowly falling here, and caused maybe a discount in their price. And right away they kind of picked it back up, and share price also followed with that. Here, now here in recent times, we can see here that their net income is also beginning to kind of fall, showing a downwards movement here. And maybe that's maybe where they've guided lower for the upcoming year. Maybe they guided lower for 2019. Maybe they're continuing to guide lower for 2020. Maybe just seeing some of that muddle in the air. So the price has kind of followed along with their guidance. So that could be it. Who knows? Not any sort of financial advisor, any sorts. I'm just kind of looking at the graphs provided and just kind of getting a general idea of what could be going on with it. So let's go ahead and look at their earnings per share as well. Normalized earnings per share over the past 10 years. Let's look at if they are going positive or negative, and they've just been going nice and positive here. You can see that their earnings per share just has recently dipped, and that could be what's kind of causing their price to also dip at an average price. So just something to kind of look at. Now, we're going to go ahead and jump into our fourth company here. This is ticker symbol UGI Corporation. This is a utility company. I believe I actually own this one as well. Quick disclaimer, I think I bought this one recently. I believe so. Without looking at my portfolio right now, I believe I just started buying it. And it is trading in the 1 year, looking at it now, it is trading near 52-week lows of $41.62, putting it below its 50-day and 200-day moving average over the past 10 years. Kind of looking at the graph, if we're looking at highs or lows for the yield, starting yield, we can see that it had lows of around 1.75% starting yield, almost 2% actually, right around 2% or less. And now it is offering a 2.91% starting yield at a share price of $41.62. If we look at this over the past 10 years, where has this company kind of gone? It's been in a positive direction. Let's go ahead and remove some of these, and we'll just look at the price appreciation over the past 10 years, throw the percentages in there. So this company has appreciated roughly 153% over the past 10 years, or 15.3% on average per year. You can see some high times where it just kind of the price exceeded where it was really needed to be. It came back and corrected, touched. If we kind of just follow the line here, the trend, if you just kind of trended sideways and made a line through here, you probably expect it to be right over here actually, just kind of waving in the progression of the price. It is trading, from highs to lows by quite a bit there, from say 250% returns over the past 10 years to now dropping 153. So it lost about 50% there just recently. Now, what causes, looking at the revenue, net income, and free cash flow, we can see what kind of causes here in the orange. Their revenue began to dip here recently, going into maybe end of 2018, maybe they guided lower. Here in the red, their net income also fell quite hard, going down. It looks like maybe 20, let's go ahead and just look at the shorter time frame graph. We can kind of see this a little bit. Okay, so 2018, end of 2018, their net income fell, and going into 2019 began to fall, and recently towards the end of 2019 hit a bottom, and they've shown some recovery. Also here in the revenue also began to kind of fall, hasn't shown any sort of recovery there, but it's not falling as fast as their net income, so they're still trying to generate some revenue. And their free cash flow also fell. So maybe they just kind of fell on some really hard times right now, not digging into it deeper, but that has definitely affected their share price here in recent times. But long Dividend Aristocrat, all of these companies have been growing and paying out dividends for the past 25 years, which means they have continued to grow and pay dividends during recessions. So even though they come across hard times right now, they've always continued to grow and pay out dividends for the past, UGI here, should be down in this area, has been growing and paying out dividends for the past 34 years. So a little blip here, and their revenue, net income, and free cash flow may be recovering here in the short term. So this price correction just may be overshot. And let's go ahead and look at their earnings per share over the past 12 months. and take away the percentages here, you can see a sharp drop here. So we can see what caused it here recently. They guided quite a bit lower going towards into 2019. 2019, they continue to guide lower. That is what rocked their share price. So here they had very nice growth going up with their earnings per share. Guess what happened to that share price? Began to grow as well. And then they guided lower. They obviously couldn't finish it. It's guided lower. Their share price followed. So here they're guiding higher again. So interesting, interesting. One thing I didn't cover with the other ones that I do want to cover is their price to book, price to sales, and PE ratios. That's something I always want to kind of go into. There's always so much information you want to cover on companies. So price to book, this is a asset-based company. It's not really sales driven. I don't suppose utilities. I would say they're more asset-based. This one, anything below 3 as far as price to book and price to sales is what I would say good for myself. And this was at a 2.1 and a 1.1. Let's go back and look at Cullen and Frost. It's a financial institution. You'd want to look at the book value. Price to book of 1.7 and below. This one's at a 1.5 with a PE of 13.71. UGI had a PE of 19.82, coming down hard from over 30. Genuine Parts has a PE of 17.79. I think that's probably about midpoint for these style of companies. It's a sales-driven company. It sells car parts. It's at a ratio of 0.73, putting it at a less price in comparison to their actual sales. Book value, not so important than a sales-driven company. Nucor Corp, it's a gold mining company. I would say it's probably more book value at a 1.3. It's still below 3, and their price to sales is at 0.64 with a PE ratio of 11.58. So I really wanted to go back and hit those. I'm sorry I didn't provide that earlier. We'll kind of go into those in the future as we cover the remaining companies. So let's go ahead and jump into our fifth company, which is Sonoco Products, ticker symbol SON. So looking at the 1 year, where is this company currently trading? It's not really at highs. We can see here some highs were right around $66, $67. It's actually trading near 52-week lows. You can see here recently it's almost touched 55. So I would say that's really close to 52-week lows at $57.61, putting it below its 50-day and 200-day moving average. If we look at the starting yield of 2.95%, almost 3% there, that's almost one of the highest points over the past year that you'd be able to buy this company for over the past 1 year. Now, we want to look at also over the past 10 years, how has this company done? It's had some pretty good growth here over the past 10 years. You can see that price growing over the past 10 years. If we look at it percentage-wise, it's gone up roughly 99.62% or 9.9% on average per year. And it recently has had a bit of a pullback coming back from, I think that's maybe 2019, just beginning to kind of pull back. If you look at the revenue, free cash flow, net income, percentage-wise, we don't really see a whole lot that's recently kind of happened to them. Nothing's, in the charts right now kind of showing. Some of this data is sort of incomplete because maybe they haven't announced it yet and they're going in the earnings season here soon, or we're kind of in the middle still of some of the earnings kind of getting released. But we can see where their revenue has been decreased in the past, and that kind of affected their share price, just kind of not growing anymore. It traded higher for quite a while, just kind of sizzled. Recently had a spike when their revenue began to show a little bit more growth. Their net income began to show a little bit more growth. For cash flow also began to kind of show a little bit more growth, and then recently kind of tapered off, and that's what happened with their share price there. And if we look at let's go ahead and take out the percentages and just look at their price to book, price to sales, price earnings. We can see that Sonoco, I forgot what type of a company they are offhand, but we're looking at, say, a ratio of 3 or lower for their price to book or price to sales. I'm not sure. I think they may be sales driven. So both of these are not too high. We can see the PE is at 17.95. They had some PE of over 30, so you're definitely getting at half of what it was valued at. So their earnings has been growing in recent times, and their price has been falling, putting them at a better PE ratio. And if we look at their earnings per share here, over the past 10 years, their earnings per share does fluctuate. So maybe it's not always doing so well. If we look at the price as well here, we can see that the earnings per share began to fall here, and share price just did not do well. You can see investors kind of negative there. And then recently, their earnings per share began to grow, their price began to grow, and it does look like they're projecting higher there. So this company may see some recovery here in the future, just in the short term, going through some rough patches, which many companies do have. So let's go ahead and jump into our next company, Kimberly-Clark. I know this is actually in my portfolio, so quick disclaimer, I do own Kimberly-Clark, ticker symbol KMB. Looking at it currently over the past 1 year, this company is trading near 52-week highs or at 52-week highs, actually almost really close to there. It is trading at $144.74, putting it above its 200-day and 50-day moving average. We can see that over the past 1 year, its highest starting yield was around 3.4%, and now it is offering a 2.85%. So this company has definitely been growing and moving to new 52-week highs. So over the past 10 years, this company continues to grow and continues to grow its share price and show appreciation. This one's very popular with a bunch of household products. So let's go ahead and bring in the revenue, net income, and free cash flow. Look at it percentage-wise over the past 10 years. Over the past 10 years, share price gone up 156% or 15.6% on average per year. But if we look at their revenue, net income, and free cash flow, it really hasn't gone anywhere. If we just kind of remove these and just look at its revenue, free cash flow, net income, revenue down 5.18% over the past 10 years. So not a really good sign there, but the price is still continuing to grow. Well, maybe we'll look at their earnings per share, and maybe that's what's kind of driving this price appreciation. Also, net income 15.91% and their free cash flow down 37.21%. This is over 10 years. 10 years, and they're negative in revenue, negative in free cash flow, and barely up in their net income. That's 1.5% on average per year. So let's go ahead and look at some of their other ratios, such as their PE, their price to book, price to sales, and earnings per share. So here we are over the past 1 year. It's going to show us just a little, we'll go 5 years. Okay, so earnings per share is rising here recently. So they're beginning to kind of show a little bit of recovery since looks maybe midpoint. So starting in 2019, their share price got hit really hard just a few years ago. They were down really hard, below $100 mark. I know Ian over at PPC Ian's channel was covering Kimberly-Clark. He had been buying it. I believe that's when I started to really kind of buy more of this company myself. And just recently we can see that what had driven that down was their earnings was falling. Now 2019 they began to recover, and they have growing earnings per share. Their other financial metrics, as far as their revenue and income and free cash flow, have not been growing. But this one, as far as their earnings per share, it is showing recovery there, and that's probably what is causing their price to move higher. So here, if we just remove, we're not going to remove anything, but we'll look at their earnings per share. Right here, when their earnings per share begin to move higher, look at their share price. Where did that go? It went up. So earnings per share was a big driving factor for this specific company. Now, looking at their other ratios as far as PE, price to book, price to sales, this is a price to sales driven company. Lots of products. Tissue is one of their, when you have a Kleenex is their brand. So if you want a tissue, you're trying to blow your nose, you think of Kleenex right away. You don't think of any other off market brand. They also have many other cleaning products. So this is definitely a sales driven company. So anything under 3 would actually be fairly valued as far as their sales goes. So you're not getting any 1 for 1, but you are getting at a 2.7, which is still below 3, but it would be up to you. Do you think it's highly priced for this current time? Or do you think it's, if you're jumping into it right now, it's not too bad to kind of dollar cost average in any company that you're researching to invest into. Its PE ratio is at 23.2. And its book value is at 116. So not a book value company that may not have a lot of assets. So you're looking at that price to sales. So that is going to be Kimberly-Clark. We're going to go ahead and cover Coca-Cola, another company I used to own but do not own at this current time. So Coca-Cola is trading for the current 1 year at 52-week highs. I believe I got a notification that they just hit 52-week highs just a few days ago, and we can see here on the graph at $59.61, putting it quite a bit higher above their 200-day and 50-day moving average. Now, if you had bought this company less than a year ago, you would have locked in a 3.4% starting yield, which is very nice for Coca-Cola. And now it is offering a 2.68%. That is a big difference there, almost a 1% difference in starting yield just over the past 1 year. So maybe a little bit high priced at this current time. Let's go ahead and see what's caused this here. Let's go ahead and bring in their revenue, net income, and free cash flow. Look at it over the past 10 years, and let's look at it percentage wise, what's gone on with their company. So over the past 10 years, a lot of the growth has came recently. You can see here that they were up a little bit above 60%, and just recently, boom, huge spike to the upside. So price, about 12% over the past 10 years on average per year, or 120%. Now, Coca-Cola, I did buy it. I saw some weakness in the company, and I believe I bought it maybe 2018, 2019, held it for a little bit. It wasn't too much. It made its recovery. I wasn't able to buy as much as I wanted of it, and I just decided to kind of sell it off, move my funds into other companies. And we can see here what had caused them to kind of go stale for quite a while was that their revenue, free cash flow, net income were just not going anywhere. It wasn't until recently in 2018 that they began to kind of show some of the recovery. So here in 2018, they kind of went into the year down, as many companies did, with their price, hit a bottoming point, and then began to show recovery with their revenue, free cash flow, and net income to the positive side. And that is why we've had explosive growth there in Coca-Cola. And I'm sure if we look at the earnings per share as well, let's go ahead and look at these other numbers here without the percentages. Look at it here in the past 10 years. I think that may be a little bit too much. Yeah, we'll look at 5 years. So over the past 5 years, we can see this big decrease here in the earnings per share. That's why their price really wasn't going anywhere. But 2018, guess what happened with their revenue, net income, free cash flow, and also their earnings per share began to come out of the ground there. And again, if we bring in the price, we can see how this has affected their price. So purple is their earnings per share. Purple right here. They began to fall. They showed recovery. Earnings per share began to grow quarter after quarter. Price began to rise quarter after quarter until they are now here at $59.61. Now let's go ahead and take out price. Just look at their PE. I still believe their PE is fairly high, but this company looks like it trades a high PE ratio in history. You know, it's at 28.8, and this is a 5-year time frame. So you're actually getting this at pretty average for this company for the past 5 years. There was a bit of a high peak here. This is due to their earnings having fallen so fast and so hard, where their share price didn't fall as much. So investors still believed in the company, still had their capital invested. Earnings were falling. Their PE was rising heavy. Now that they've increased their earnings and begin to recover, their PE is dropping back down to their average. Also, book value as at 13.46. This is more, it's Coca-Cola. It's very sales driven. So you're looking at that price of sales of 7.0. So I would think it's a little overbought and high price. With anything over 3 at this time, I think it was a little bit hard. If we look at it here over the past 3 years and we take out, we can see also their earnings per share. We already kind of covered that. So I just want to show you how their price per share has been affected here. We can see here over the past time frame. So here is their price. Yeah, this one's it trades very high. You don't really get a price of sales of anything around 3, not since, yeah, not for quite a while. So it's a very highly priced company, and that's pretty normal for Coca-Cola. So that is going to be Coca-Cola. Let's go ahead and jump into number 8, which is John Willie and Sons Inc. Ticker symbol JW.A or -A, depending on the broker. So looking at this company here in the short term of 1 year, This company is trading at 52-week lows and has just been here for quite a while at $44.26, putting it below its 50-day and 200-day moving average. It is offering a high starting yield of 3.05% over the past 1 year. It just kind of been in this stage. It really hasn't gone anywhere. I'm not familiar with this company, so if you know this specific company, let me know in the comment section below a little bit more about it if you would like. But we'll kind of just look at their metrics here: revenue, free cash flow, and net income. We can tell a lot by those, the statistics that we kind of go over. We've seen what has caused the price to decrease or increase by using these metrics. That's why I really like to look at revenue, net income, free cash flow, earnings per share. You can see a lot about a company, what caused it to fall or rise, by looking at these specific metrics. So here over the past 10 years, let's go ahead and look at their percentages here. Over the past 10 years, this price has gone up 8.69%. So that is 0.08% over the past 10 years? Or yeah, about 0.8% on average over the past 10 years. Well, that is not good growth at all for the share price. So a lot of shareholders, not as bad as Exxon, but still not a whole lot there. So what causes? Well, the revenue really hasn't gone anywhere. It's at 7.72% or 0.7 per year. Their net income also 2% over the past 10 years. So this company just kind of flapping and not really moving. Their free cash flow is down over the past 10 years, 36%. So this company is just kind of stagnant. It's not going anywhere. It's not having rising revenue. It's not having net income. It's not having any free cash flow. So this company is just kind of, it's there. It's just in business, but it's not producing any sort of capital to really make it chug higher. Now, if we look at the price to book, price to sales, PE, and its earnings, we'll probably kind of see a little bit more about its earnings. So, earnings were kind of moving sideways for a while, dipped. Look at the price in here. And that is a lot of information there. Okay, so share price is in the blue, earnings per share is in the purple. So purple, earnings began to fall here, price began to follow. Earnings per share kind of trended upwards here for a short time. Price began to show some recovery, just kind of trended sideways. Earnings per share grew higher, into the $3 and some shares, earnings per share. Price began to kind of follow, and they just kind of decreased guidance and just been falling. So earnings per share is right now it's falling. There's really you're not able to kind of see where it's going in the future. Earnings per share right now, it's down, it's trending downward. So this price could continue to fall. We've already seen its revenue, its net income, its free cash flow. I think this may be one of those companies that's kind of, it's on its last threads is what I would kind of call it. It's not all quite there. Maybe they can kind of turn it around, but it's going to take a lot to turn this specific company around. It's a huge company, obviously been around in business for quite a while. And its earnings just isn't doing it for it, and that price is showing it, and their free cash flow, net income is all sort of down. So this is probably one of the worst performing ones that I've kind of seen of the 10 that or the 8 that we've covered so far. This is kind of a weak one. And also, let's go ahead and get rid of the price. Well, let's look at the other values here. So book value 2.1, sales as at 1.3, their earnings per share, we've already seen it's been decreasing, no end in sight there, and it's PE of 17.29. Now, if you were only looking at these ratios, they may look pretty good. Company trading at 17.29, it's not really too high. If you looked at the earnings per share, it's at 2.83. You'd really have to look at the history. That's why it's important to look at the history and see if the company's moving higher or lower. And price to book, price to sales, those do not look like bad ratios. But it's not really trading at a discount. I think it has some rough patches going for it in the future. And I think that's good for that one. So let's go ahead and move on to Pepsi, the opposite, or very similar to Coca-Cola, one of my other favorites. I own Pepsi as well. I don't know if I own that one still. I really should. I think Pepsi is a great company. And if I don't own it, I definitely should have, right? Okay, so looking at Pepsi, ticker symbol PEP, Looking at it in the 1 year time frame, is this trading at highs or low? You can obviously see it's trading near 52-week highs, or I think today it did close at 52-week highs. It looks like it's boom right at the very top. It's at $146.47, putting it above its 200-day and 50-day moving average, and it has a starting yield right now of 2.59%. Now look at the history. Back 1 year ago, less than a year ago, you could have bought this company with a starting yield of 3.15%. But if you look back a little bit further, back here at the end of 2018, okay, that's when we were kind of looking at it. So right around 3.3, 3.4% plus. It's raising its dividend year after year. So why you would have bought it at say a 3.3, they increased their dividend year after year. Not a huge amount. Recently in 2018 they increased it by quite a bit. Not a lot in 2019, but still just continuing to growth with all these companies. Okay, so let's look at this company over the past 10 years. So we already see it's kind of high priced at this current time frame, not really providing a buying opportunity or a value. So now if we look at their revenue, net income, and free cash flow, look at it over the past 10 years, bring in the percentages in here, we can see that over the past 10 years, this company, Pepsi, has appreciated about 140.4% or 14% on average per year. Revenue, free cash flow, net income is also been growing. Revenue in the orange at 48% or 4.8% on average per year. Free cash flow 17%, and net income recently spiked here at 98% over the past 10 years or 9.8% put on here recently. So big spike there. It was actually negative and just recently popped up. That's kind of interesting, and could be why they've had some nice growth here in the short term with Pepsi. So let's go ahead and we'll leave their price in there, and we'll bring in their price to book, price to sales, PE, and also their earnings per share, and look at it in the 5 year time frame. So price is in the blue, earnings per share is in the purple. So price and earnings were kind of growing here side by side. Yes, they had some little downturns here in a quarter, but then they kind of recovered. Their share price kind of dipped there for that quarter, and then they recovered. Share price followed. Here they guided lower with their earnings. Share price had, maybe investors were kind of taking this opportunity, seeing a double bottom. They kind of bought into it. Share price appreciated just a tiny bit, but earnings continued to fall, so investors lost confidence. Price fell and hit a bottoming out point there where investors kind of felt comfortable buying back in. Earnings here at the looks like maybe end of 2018 began to rise again. Investors began to get confidence, buy back in, and share price kind of followed. So earnings took a bit of a dip, as they always do, just over the past, just history of all these companies, and that's kind of what caused their share price to kind of stall out for a little bit, but has spiked here in the short term. So let's go ahead and remove their price, look at their ratio, their ratio. So price to earnings is at a 16.72. This is kind of dropped down because of their earnings having grown, but their price has also grown. So if their price had kind of remained the same, but their earnings had grown, they'd probably actually be around a 15, potentially, maybe right around there. But their share price has appreciated, along with the earnings, causing the kind of slowly uptrend altogether. Now sitting at 16.72. Their price to book is at a 14.46, and this is again another sales-driven company. So we're looking at the price of sales, and that's at a 3.1. This is actually not too bad. I would say it's. And obviously, when you look at the price, it's very high priced in this current time frame of 1 year. But overall, not too bad of a ratio there of 3.1. And it has had rising earnings now. We can see this one. I'd like to kind of see how it plays out. It looks like it might be, poised for a bit of a pullback there. But we shall see what kind of happens in the future. So that is going to be Pepsi. I think it's high price at this time. But let me know in the comment section below, what do you think of Pepsi here in the short term? And let's go ahead and move into our last and final company, which is ticker symbol CLX. So Clorox company, look at it in the 1 year time frame, has had a huge spike. Quick disclaimer, I do own Clorox, ticker symbol CLX. So in the current time frame, it is trading almost near highs at $164.77, putting it quite a bit above its 52 and 200 day its 50 and 200-day moving average. So a bit high for the past year. It is starting yield of 2.51%, which is not at the lows here of say 2.3 some percent, 2.3%. That's when the share price was back exactly where it was at now. So they have raised their dividend here recently, which is what caused, here's their dividend increase back in July of 2019, it looks like. So I don't know if this kind of shows that spike here. Maybe, I don't know. But starting yield 2.51 seems kind of low for the time frame over this company, and this company is kind of trading almost near 52-week highs. So let's look at their price, and we'll kind of go into their financials now. Revenue, net income, free cash flow, percentage wise over the past 10 years. Clorox has appreciated about 177% or 17% on average per year. We can see a nice little dip here in Clorox back just a few years ago, and their revenue, net income, and free cash flow has just been steadily rising. It's not huge. Again, this is a Dividend Aristocrat, and it's Clorox. They sell name brand cleaning supplies that bleach, for example, very popular one. So it doesn't have a lot of growth, but it's just slightly grown at around 3% for their free cash flow, about 3.5% for their net income, and their revenue is up about 1.5% per year, or 15.61% over the past 10 years. But still, investors really like and enjoy this company. It's safe, and share price shows that up over the past 10 years. Now let's go ahead and bring in their price to book, price to sales, price earnings, and earnings per share. Move it back to just normal statistics, and we'll look at it in the 5 years. So over the past 5 years, this company doesn't show data here, anything prior to 2017. It looks like it's not showing me that. Oh, I clicked on the wrong one. Okay, so there we are. Looking at it in 5 years, here's their earnings per share. So in this time frame right here in 2016, share price is moving higher as their earnings per share was moving. Earnings per share began to dip, had a bit of a dip there. Share price fell. Earnings began to grow higher. Share price did not follow that, even though their earnings were growing. This was a buying opportunity here in this time frame. Earnings were showing good, consistent growth, but share price did not show that. This would have been a buy at this time. If we throw in the yield in there, we can see that during this time frame, end of maybe 2018, maybe mid 2018, it was offering a nearly 3% starting yield, quite a bit different than this 2.51%. So that would have been the opportunity time to buy this company, Clorox, but investors continue to kind of see that this company is chugging higher. Some investors took opportunity in it, and it's at $164. I don't think it's overbought. It actually looks like it stalled out for quite a while between, let's look at it, 10 years. Looks like it stalled out from around 2016 to, maybe that wasn't, we don't need to go back that far. From 2016 to about 2018 midpoint, it kind of stalled out, and its earning began to rise during this time frame. Price began to kind of follow that, and I don't think it's done growing. I think it's maybe plateaued here for a short time. It definitely has more room to kind of fall versus grow if you're just kind of looking at it, looking at the history of it. But if you think that the earnings is going to continue to grow, we could probably see Clorox continue to grow higher and just not have too bad of a pullback because of this consolidation here over the past year or so. So looking at it now without the price, looking at the ratios here, a sales-driven company, so we're looking at price of sales in the orange at 3.4, not below 3, but right in that area of 3.4. PE ratio of 25.87. Price to book, not too important for a sales-driven company, but it's at 37.14, and its earnings is growing at 6.37. So very nice company there, Clorox. So one of those high flyers. So we've actually had a pretty good mix of companies that may be potentially buying opportunities. I will try and, I'll be watching this video again during the replay. And as I've seen companies kind of get reviewed, we'll kind of put a star, an asterisk next to companies that look like potential opportunities where they've had good financial fundamentals, but they are just trading not at their 52-week high, which could be a good buying opportunity. So I will leave that for you to decide. Let me know in the comment section below. Do you own any of these companies here in today's video? I would really like to hear from you. What do you think of these videos? Do you like going into the information? Do you think it's too much information? Do you think it's a good amount of information you're able to kind of digest and see how I look and kind of see companies? Here I went through 10 companies. I could see why they grew or fell in price. I could see their earnings, their revenue, their net income, free cash flow, and I could use those metrics to see why the share price did what it did. And I think it's very helpful to be able to do this very quickly, as you can kind of do 10, 20, or 30 much faster than what I did because I don't have to explain it. So very nice information. So that is going to be it for today's video. Again, if you did enjoy this video, I would really appreciate it if you do smash that thumbs up button below. If you have not yet subscribed to the channel, again, subscribe to the channel, hit that little red button below. And if you have any comments or questions going over this video, the stock market, M1 finance, want to let me know if any of these holdings are in your portfolio, let me know in the comment section below. And if you have any opinions on them after I kind of covered some of the information, thank you all for tuning in. If you did last until this point, I really want to thank you for sticking around. And of course, just let me know in the comment section below. Let me know that you stuck around to the end. Thank you all for tuning in. I will see you next time. Have a great day. Bye.